And begin. Zero hedge. It's been a long time, been a long time, been a long, lonely, lonely time since Jason at 4 has done some zero hedge newsworthy videos. I think here's a good time for one or two. Does the Fed balance sheet normalization signal the next asset collapse has begun? Remember, they're trying to take this $4.5 trillion and knock it back down. All this phony money was printed up, given to the banks. You and I didn't get to touch it. All they had to do was give it to us, and we would have paid our bills. Pay that credit card off, pay the car off, pay this debt off. Maybe you didn't have enough to pay the house off, but at least you got this other debt out of the way. You can at least make your freaking payments. Nope. Give it to the banks. And then on top of that, the banks, you still foreclose on this? Yep, they get the house too. They get the cash, and they get the property. You get nothing. Good day, sir. This is authored by Chris Hamilton of the Economica blog. After nearly half a century of unlimited dollar creation, after nearly a half century of unlimited dollar creation, multiple bubbles and busts, the current asset reflation has been the most spectacular, but alas, perhaps too successful. The Fed's answer to control or restrain this present reflation is raising interest rates to stem the flow of business activity, lending, and excessive leverage in financial markets. But in the Fed's post-QE world, a massive $2 trillion in private bank excess reserves still waits like a coil under tension, ready to release if it leaves the Federal Reserve. Thus, the only means to control this centrally created asset bubble is to continuously pay banks higher interest rates, almost like paying the mafia for protection from the mafia, not to return those dollars to their original owners or to put them to work. With each successive hike, banks are paid another quarter point to take no risk, make no loan, and just get paid billions for literally doing nothing. We give you the money to the banks, and if you park it back with us over here at the Fed, Treasury window and or Fed, we're going to give you interest on it. How would you like me, if I was this huge multi-billionaire, to just hand you money? You don't have to do anything. I'm going to hand it to you. And I've got this wonderful program. You're going to put it back into one of my companies, the same company that actually gave it to you, and I'm going to let you earn interest on it. It's kind of like it's both of ours. We'll just keep it over at my place. You get it for free. You get to earn the interest by parking this money that I gave you back over at my place. You don't have to do anything else. Pretty sweet deal, isn't it? Pretty effing sweet, isn't it? The chart below, which we'll go ahead and pull that up. Take a little look-see. The chart below shows the nearly $4.4 trillion Federal Reserve balance sheet acquired via quantitative easing, red line. Nearly $2 trillion in private bank excess reserves, blue line. And the interest rate paid on those excess reserves, which is the black line. While the Fed's balance sheet has begun the process of what we call normalization, declining from peak by just over $100 billion, which is nonsense. Bank excess reserves have fallen by over $700 billion since quantitative easing ended. So what? The difference between the Federal Reserve balance sheet and the excess reserves of private banks is simply pure monetization, the yellow line in the chart below. This is the quantity of dollars that were conjured from nothing to purchase treasuries and mortgage-backed securities from the banks, but instead of heading to the Fed to be held as excess reserves, went in search of assets, likely leveraged 2 to 5 times, resulting anywhere from $3 trillion to $7.5 trillion in new buying power. From World War II until 1995, equities were closely tied to the disposable personal income of the American citizens, DPI representing total annual national income remaining after all taxation is paid, which is the blue line. However, since 1995, lower and longer interest rate cuts have induced extreme levels of leverage and debt. The Fed actions have created progressively larger asset bubbles, more divergent from disposable personal income at peak, but falling below DPI during market troughs. But after the 2007 bubble, the pure monetization found its way into the market with spectacular effect. As the chart below shows, the Wilshire 5000, which represents the market value of all publicly traded U.S. equities, which is the red line, has deviated from the basis of U.S. spending, U.S. total disposable income, which is the amount of money left nationally after all taxes are paid, in the blue line. In the chart below, the growth in monetization has acted as a very nice leading indicator for equities, as each successive pump of new money left the Federal Reserve and entered found its way to the market in search of assets subsequently reacted. Likewise, each drawdown in monetization saw a similar pullback in equities. What happens next? The Federal Reserve plans to systematically reduce its balance sheet via raising interest rates on excess reserves. This is to incent and richly reward the largest banks to maintain those trillions at the Federal Reserve. As the chart below shows, theoretically this means the monetized money is set to continue evaporating, and assuming it was highly levered, then the unwind and volatility of deleveraging should only continue to worsen. And if the Federal Reserve is true to its word and even halves its balance sheet while banks maintain the excess reserves at the Fed, then all the digitally conjured $1.5 trillion is set to be unconjured. Again, assuming the monetized monies were at least somewhat levered, the unwind of that leverage will continue to produce a chaotic and volatile slide in markets. And as the chart below suggests, if equities and broader assets follow the unwind of the monetization, then equities are likely on their way back down to and through their natural support line, disposable personal income. Conversely, I've included the 7.5% long-term anticipated market appreciation for reference, green dashed line. Quite a spread between those differing views on future asset valuations. Of course, the data-dependent Fed could change its mind, but perhaps this is something worth thinking about. And it might be something where us crypto-tards ride. Crypto-tards, we ride as that money flees those markets and wants to go somewhere because they got used to those nice interest rates, those nice returns. Oh, market, yeah. And then that kind of thing happens. Where do I put my money? Where do I put my money? What do I do? What do I do? Oh, cryptos. Cryptos. Hello, cryptos. And then you and I, who've been buying all this time in cryptos, not screwing around with that market at all, the regular markets, the equities and whatnot, we've been here waiting patient. Glad you guys could show up. Oh, what's that? You want some crypto? Yeah, listen, there's not very many of us, technically speaking, across the world that have it. But we do have it. And I've been hodling for a long time. And I don't like the prices today, even though they're fantastic. I think there's a lot more room to grow. I'll sell you a little bit right now, but not a lot. And maybe some other people will sell you guys a little bit, and then keep pushing the price up. And you might push it up high enough to where we decide, you know what? Now we're happy. Now all you people chasing yield, you can come over here and chase it. I'm going to sell a bunch, pay off the debt, you know what I mean? Pay off your debt, pay off your stuff you wanted to pay off, or buy something you wanted to buy the whole time, some property, some investment, whatever it is. And you get to pat yourself on the back and say, wow, I really was one of the smartest guys in the room. And I'm not some JP Morgan bankster. I'm not this big investment firm. I'm just a little guy. Just a little guy who saw something, recognized what it was. Maybe he didn't agree with old Jay Snip and some others back in 2017, but I do now. Thanks, guys. No problem. You're welcome. We love you. Welcome to the club. And all that money flows over to us, so to speak. That could be an interesting development, but you never know. The data-dependent Fed may have to change tunes. Oh, we're going to reverse. Lower the interest rates again. And by the way, we need to buy some more mortgage-backed securities because the market's still at an all-time high. Nobody can pay their bills. So the real estate market. And yeah, we're going to have to deal with that again. And that's hopefully you and I, crypto's doing this. Ooh. Housing market nonsense. Ooh. We're up here. Housing down here. Buy some of that stuff. Boop. Meet in the middle. Save some of my cryptos. Take some of that cash. Buy the property. Investment property. Get a management company to run it. My buddy Dave will tell you all about it one day. He's an expert with that kind of stuff. Take care.